Hey traders, this is Blake Morrow with Traders Summit, and with me today I have Mr. Jim Welsh from Macro Tides. But before Jim, we go on, I need to mention to people, over 80% of the people that view these videos are not subscribers of our YouTube channel. So if you like this content, make sure you give us a thumbs up. Make sure you subscribe to the channel so you don't miss any of our great content. Now, welcome, Jim. How are you?
Drum roll. Happy Friday to you and everyone else, even though they'll be viewing this probably not on Friday, but that's okay.
Yeah, they'll probably be reviewing this over the weekend, seeing what your views were. And, we're going to start off with really just talking about bonds. I mean, bonds rallied from a really critical level of support this week. They bounced and then, yields fell. And I think that caught a lot of people off guard. I think a lot of people were expecting yields to continue to rise, but we saw this bounce from the bond market. What do you make of it on the 10-year?
Well, as you know, because we've been talking, I've been talking about being short the bonds because of all, inflation, technical reasons, and everything else. On Monday, I suggested covering 75% of that short because I thought there was 5 waves up on the chart in terms of yields, and obviously 5 down in terms of the 10-year price, and that we were due a rally in terms of bond prices rallying. And I thought the 10-year could get down maybe as low as 145. I think it got down to about 150. So this decline, I think, is just we were oversold in terms of bond prices. So we were due a bounce. And I still believe this fits into the overall picture that ultimately I believe the 10-year is going up to the 176 high from last March. And maybe, above 2%, we'll see. But pattern wise, I think this is like a wave 4 and we're going up again to make higher highs.
That's interesting. All right. Well, I think that might freak out a lot of people, especially in equity. So we've had this really nice bounce in the S&P over the last, this week. And I think that has a lot of bulls pretty excited. So how are you feeling about the S&P?
Okay, just from a fundamental standpoint, I think earnings are going to come in on balance really pretty decent. So far, we had bank earnings and so forth. But when we get to the real economy type companies, I think the earnings are going to be pretty decent. But I think they're also going to be talking about, the costs of wages, raw materials, supply chain disruptions, and so forth. So I think there's a little cold water that's going to get thrown in on a fair amount of these reports that are coming in the next 2 to 4 weeks. So that's the fundamental side.
Okay.
Technically, the S&P dropped from 45.
Now, Jim, I'm actually gonna pull over the S&P chart really quick so people can see it. What you're discussing. So let me grab it really quick, and from here, people should be able to see the chart. Can you see the chart?
Yeah. Yep.
Okay.
Beautiful.
So let's walk me through technically what you're seeing here. We got this big wedge. We broke out of that a few months ago. What are you seeing here?
Right. Well, from the high in early September at 45.45, the S&P dropped to the low of 42.80. And I believe that's wave A of a bigger correction. So it dropped about 265 points. Then we had a move up, a pullback, and now we're pushing up again. I think we're nearing the end of an ABC rally for wave B.
Okay.
And just in terms of numbers, the first leg of this rebound was about 150 points on the S&P. It then pulled back to 43.30. So 150 added to 43.30 gets you 44.80. So I actually took a partial short position this morning when the S&P hit 44.70. Because this thing can continue. I think options have played a big role, especially on Thursday, because you have options expiration on Friday. As the S&P moved above 4,400, I think that triggered a lot of option activity, which does in fact influence the market, especially around expirations. If this analysis is correct, Blake, what it implies is, let's say the S&P does in fact top at 44.80, a subsequent decline of 265 points would target a low around 42.15. And, that's my bet, is that I think we're going to see another leg lower in the market over the next 2 to 3 weeks. And at a minimum, the S&P will drop below 42.80 with an ideal target, if you will, at 42.15. If all thing is copacetic at that point in time, what this would imply is this is a wave 4 pullback at the S&P to be followed by another rally to new all-time highs. So it's a correction. I still think the uptrend is intact. The economy is in decent shape, as the retail sales number showed us. But I also think the consumer price report, Blake, was clearly not good news if you're from the Fed standpoint, because core inflation continues to kind of hold up there. And people are just starting to talk about shelter inflation in terms of rent and home prices, how that bleeds into the core. It represents over 35% of the core CPI. So we're going to see the core CPI really hold up, even as some things come down because of the weight of the shelter component over the next 6 to 12 months. They're going to continue to kind of push it upward. And I think that's what is really problematic for the Fed. They're going to announce November 3rd, which, as you know, for the last 2 months, that's been kind of the target date. But one surprise is, hey, they raised the idea of potentially starting in mid-November, not December 1, and certainly not January 1. I thought 15 billion. They may actually go a little bit more than that. There's a bunch of them who Fed members, FOMC members, who kind of want to get the tapering taken care of because they are worried about inflation and they want to have, if you will, a clean deck to deal with in terms of, okay, we got that done. Now we can look at the economy and decide when and if rate increases are going to be appropriate. So I think that's one of the negative surprises that the market, I'm not sure, has completely come to grips with, that the Fed is going to announce tapering. It's going to be at least 15 billion, and it may start early. And, that potentially could be the backdrop of why we see another leg down.
Okay, well, then that might coincide with what the dollar may or may not do. So how do you feel about the dollar here? We've been struggling with this 94.50 level. Everybody knows it's a big fib level. It's a big 38% retracement on a weekly chart. But the dollar's not really pulling back. I mean, you're seeing it consolidate its gains, but you're not seeing it pull back. So what do you make of the dollar, and where do you think it's going to go, especially if the Fed does indeed start tapering quicker or farther or quicker or faster? Excuse me. That's what I meant.
Well, as you know, and we've talked about this, I was looking for a very important low late May, early June, completing a correction that started in January of 2017. That implies the dollar is going over par. But this area between 94.50, as you just noted, and 95 is some big time resistance. So the dollar is kind of extended. The high it made last week or in the last week, the RSI diverged. And I just felt that when we talked last week that it was going to have a pullback. And I still think that's likely. But longer term, I think what you just noted in terms of the Fed moving more quickly than the ECB, I think that's going to hold sway, and that the dollar is going to ultimately move above 95. One of the things that I think that has hurt the euro and has helped the dollar, because the euro is 57% of the dollar index, is the issue with energy overseas. I mean, natural gas prices have gone from $2 to $5.50 in the US. They're 3 to 4 times what we pay here. So it's causing some real dislocations over there. And I think that's one of the reasons why the euro has been weak, which has obviously helped support the dollar.
It's interesting you say that, because in our daily webinars that I do with the currency group that I'm with, we talk a lot about how energy costs will impact the average consumer, and there is a fine line. When you're talking about gas prices, when you're talking about energy costs, heating costs, and you're exactly right as far as what Europe pays, and I think everybody is really bracing for higher prices in Europe. And so how is that going to start to affect the consumer as a whole?
Right. Well, in terms of the U.S., U.S. consumer has, I think, like $1.5 trillion of excess savings relative to February of 2020. So the capacity to deal with this for the majority of people is probably decent. I think there was an estimate out of some agency in the last couple of days that the average bill would go up 150 to $200, which, it's like from, 600 to 750 or so. So I'm not sure that'll have a big impact. However, if we have a colder than normal, winter season, both here and obviously abroad, the impact then starts to rise incrementally in terms of how it acts on the economy. One thing I'll point out, in the mid 70s, oil went from $3 to $37 by 1979. And energy as a percent of GDP was about 8 or 9%. It's less than half that now. So it's important, but it's not the same kind of determinant as it was in the mid 70s. And it's one of the reasons why, Blake, I'm not on the inflate or the stagflation camp. And that's for another day to talk about that. But I think people are overestimating the idea of stagflation. Everybody likes to embrace an idea and makes them sound smart.
Yeah, right. That's exactly it. And that term, which used to be very, very cringy to the market a year ago, but today it seems to be all the rage. So let's talk about one last thing. You've had a focus on gold. We really thought gold looked like it was going to break higher this week, hit the 200-day moving average, stalled there for a day and a half, and here at the end of the week, gold's getting slammed. So what do you make of gold? I mean, again, I have to reiterate, so many people are bullish gold for all the reasons, everybody knows the reason, but it just really hasn't acted well. So tell me how you feel.
Well, I'm still positive short-term on gold.
Okay.
As you know, a couple of weeks ago, my advice was, hey, if it drops under 1730, but holds 1720, I think we're going to see a rally up towards 1800 and potentially 1835. In my mind, nothing's changed. There's a trend line that the gold hit at 1800. It's pulled back. So far, I like the way it's holding up. It's not just continuing to puke. And we've seen, Bitcoin have a big update today too. And I think there's just people that are taking cues from what Bitcoin does. Oh, then I better be negative gold. But as I noted in the last couple of weeks, when Powell didn't talk about transitory, acknowledged that inflation is going to last more into next year, I just felt that provided a backdrop that would be supportive for gold. So I still think the odds, Blake, favor that gold will get above 1800. And then the big test would be that 1830 to 1835. So my take has been, they buy it under 1730 in anticipation for this move above 1800. And then we'll see what shows up if it gets up to 1835.
All right. Well, Jim, I love our talks on Fridays, and I love getting a roundabout view on how you feel on all these big major indices. And if I'm a trader watching this, how do I find out more about what you do, Jim, at Macro Tides?
Well, macrotides.com. But hey, if you want to get some information, I'm happy always to send out like last week's weekly technical review. Send an email, Jim Welsh Macro at Gmail, and I'll send you last week's weekly technical review, or potentially, because we're talking on a Friday, next Monday's WTR.
Sounds great. And guys and gals, I just want to give you a quick reminder. You can find out all about Jim on the Traders Summit website down below in the description in the contributor area. Also, again, if you're watching us on YouTube, make sure you give us a thumbs up and make sure you subscribe to the channel. Those are both free. It's free to give us a thumbs up, free to subscribe. And this way you don't miss any of our great content every Friday with Jim Welsh. So thanks, Jim, for joining us.
Hey, Blake, thank you. Have a great weekend. And I'm going to end it with 2 thumbs up. One for you, one for me.
All right. Thanks, Jim. Have a great one.
You too.